Market Analysis. I'm Tom Nunamaker with Jim Riggio, and our guest today is Himanshu. So before we get started, we'll go over our quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I have a chart of the VIX up just in case you want to talk about it. But Jim, did you want to share your screen or talk about the VIX? Or
sure. Why don't we do this? I'm going to end up. Why don't I share my screen first? I'll go through a couple of things, Himanshu. Then I'll end up asking, your opinion, and if you have anything to end up sharing, you want to show your screen in terms of any charts, you can. So let me just go, and I need to hit share my screen. Oh, you have to give it to me first.
Yes, I have it now.
And I want to share the screen. Okay. I assume that you can see my chart of the SPX.
I can.
Okay. Now, this is a very interesting chart that I ended up drawing back in early December. You can end up seeing here that the purple lines are Fibonacci's. I drew it from the bottom that we reached in early October to the highs that we ended up reaching here. I did not redraw the line for the new highs that were made at the end of the year. And if it does, it brings the line up just this line a little bit. Some of the things that I thought were noteworthy today was that we made a new low on this, the first trading day of the second month of the year. You can see that we ended up having a new low for the year. And we came directly to that Fibonacci and bounced off of it. What an incredibly strong day. Well, we've talked about, using the capital discussions tool that Tom put in place and take at the daily ranges. Today's range in the SPX of 40 points or so did nothing to end up, minimizing or lowering, what our daily ranges have been. What it did do, though, is that we came in, relatively flat. We were up a little bit. We sold off in the morning and finished very, very strong. The last half hour of trading was extremely strong, basically from about 1:30, 2 o'clock onward, the bulls almost said enough, and they just marched us higher. And we are still very much, if you take a look at our candles, within the range. But at least now, I think that it was looking pretty bad this morning at about 10 o'clock or so, and the market just really did an about face and then coming up. You can also end up seeing the reason why I put this chart over here is that this red line is the 200-day simple moving average. And you can see we came close to touching it, but we have not, which means that between that and the Fibonacci, it looks like we found maybe, some support levels, at least temporarily. If you also take a look at the lows that we ended up making in December and the lows that we ended up at now, if you take a look over here, we've made those in early January and then later January. We broke those, but we did not break the lows that we made in the mid of December. So at this point, it looks like we're finding a little bit of strength. Next thing I want to taking from the charts, or at least from the drawings, I wind up going over to what I look at a lot of times is the oscillators. When I take a look at the oscillators, boy, they all look like, and I see this 200-day moving average. They had all sold off, and started to end up getting a bounce. Usually, and when we've talked about this, right, a Williams percent R often will be the first one to end up jumping, and it was today. CCI many times in the Russell, and in the SPX will be the next to end up moving high. If I go over to the SPX, you'll see very similar, type of chart where the CCI has actually started to move higher. So has the RSI using exponential moving averages and all the short-term stochastics. So, I mean, this looks like, from a technical perspective, that we've been range bound, have bounced the bottom of it, and we look very reasonable at this point. The last one is momentum that I'll end up sharing with you guys, and I'll come over here. Momentum. And momentum's been all over the place. One of the things that's happened is the ADR and ADRX. You can end up seeing we actually start to turn a little bit higher, which has been positive, over the last, few days. So that's what's been going on. One of the things that we had talked about in the past is that we had looked at, what was going on with implied volatility. And instead of using the Thinkorswim system, I'd much rather show you guys the chart for off of LiveVol. Hang on, I don't have it up. I need to just pull that chart up. I'm just on my other monitor, so give me 1 second. Okay, this is the chart. What I tend to look at is I want to look at the different implied volatilities. So I'm looking at 30, 60, 90, 120, 180, and 360. Everything turned down. I mean, we had been reaching levels that were relatively high. What you have seen here is a compression, what ends up happening often, when things end up selling off, like they did in December. And you remember we've talked about this. December saw two of the highest level of volatility on the VIX options. And it also, the fourth quarter, one in October over here and one in December over here, had the two largest weekly moves in the VIX since it was introduced in 1990. And you can see what ends up happening is that we moved up so high that the short term, the 30-day, actually got above the 360-day volatility here. And you can see here you got compression, where they all came together. Well, we were getting, with these sell-offs, they were getting ready to do the compression thing. And over the last day or so, especially when we caught our footing here, the compression is seen to be a little bit less intense. So if you're writing covered calls, we're doing a covered call class right now, depending on what time frame you're looking at writing your options is very, very important. And I wanted to end up showing you this graph because, Himanshu, I, and Tom had this discussion at the end of last week. Just because the 30-day volatility has sold off a lot or it might have gone up a lot doesn't mean that the 360-day, if you're using leaps as stock replacements, and I know Himanshu does that in some of his strategies, and we ended up teaching it in the covered call class also, doesn't necessarily mean that there's this one-to-one correlation. I don't know of any place else, and I'm just looking here at 6 months, but if you wanted to, you can take this thing out to 2 years. And you can end up seeing, I like these graphs because they're very clean and very easy to see what's going on with the volatility. Tom, instead of doing that, I built a graph. I just wanted to end up bringing it up over here on the volatility indexes, and if I end up coming over here for the VIX futures, and I end up changing my graph to VIX futures. Sorry, hang on a sec. I'm on the wrong one. Okay, here. So what you can end up seeing here is that I did not update after the last expiration. So the yellow is the front line. You can end up seeing that we actually got below the zero, and we have been dealing with some backwardation. Some of the backwardation issues that for people who don't want to end up building this graph out, there's a website that will end up giving it to you in delayed format called VIX Central. And here you can end up seeing my graph when you're in a negative number. This is when you're in backwardation, and let me just move this over to this side so you can see the blue. If you do it on Thinkorswim, build it out yourself, you can end up doing it at any time frame. I look at it at 15 minutes, 3 times. They do it delayed, and you can end up seeing that the front month is still in quite a bit of backwardation, but the rest of the curve starting in March is actually looking to be a little bit more normal. So all in all, there's still some short-term fear. We're still at definite risk of this thing turning around and going back down. But if we do make higher lows and higher highs, okay, this week, people will end up pointing to today as the point where we at least found, a short-term bottom, okay, this morning, okay, and it was a very strong day. Anyway, Himanshu, thank you so much for joining us. For those of you who don't know Himanshu, I guess I have known Himanshu now for probably about 5 years or 6 years. We've presented at SIBO events together. We've presented at Sheridan events together. Himanshu, I guess, got his rise to fame as a calendar trader. He would end up doing a lot of different calendars in IBM especially, but also other underlyings. Really ended up looking at the pricing of things and understanding his underlying and went up doing. He's since expanded into butterflies and a lot of other things, but he ended up agreeing to end up joining us because I know that he used technical analysis a lot in his trading, and we're very glad that he was generous enough with his time to join us today. Himanshu, what are you seeing going on in the market?
Right now, by the way, thank you for that introduction. Right now, I am seeing some very unpleasant visions of what happened in the year 2000. The market is chopping around quite a bit. It's, what is the term? It is called frothing at the top kind of thing. And as you just mentioned, that if it goes up from here, today might be the day that everybody will say, yeah, because of this it happened. But even if it goes up, I don't think it's going to go up too much. And if it does turn down, then this very well could well be the another event as in the year 2000, 2001, when the spiders went from, I believe, 152 down to 77 within a span of about 14 months.
I could definitely see the market doing that because, Himanshu, I don't know if we ended up sharing when we ended up speaking to you, but I don't know if you see my screen right now. I'm just showing you a tool that Tom put together where we can end up taking a look at what the market has done. And if I take a look at the SPX, here are the daily ranges going back to the last month. And, had we talked about this, as you take a look at this, we had a 40% move, which put us in a 2 standard deviation move. Our maximum is 53. We've been averaging over a 20-point move a day. And you and I had talked about this as traders, when the daily ranges start to end up increasing like they have, and oh, by the way, this includes Christmas week. Right, and you look at here, Christmas week where we had single-digit moves,
yep.
Right? Much, much smaller. And you take a look at some of these moves that we've had, and they've been getting larger. And when that ends up happening, what ends up happening is that you get the bulls and the bears fighting, and we're not sure which is going to end up winning. But I do think what ends up happening over the next, and it'll play out, as you said, at the beginning of 2000, or, we'll end up seeing it play out over the next couple of months. I think we are going to have a sizable move in one direction or the other. The only problem is my crystal ball doesn't tell me which way we're going to go.
That is very true. And there are also some other statistics which actually tell us that if the month of January is a red month, the whole year usually is red. Of course, we have had quite a few exceptions to that rule, but if you go back over the last 80 years, that has been the case more often than not. And this January was a red bar. So that is another reason to be a little bit more concerned on the downside. Make sure that for those of you who have a lot of long positions, that you are hedged on the downside. Buy put calendars in the spiders 5% below the current price. Long-term leaps. That's what I would do. In fact, that's what I did today.
I think, the nice thing about and we had mentioned, Himanshu, okay, with my work with the EV Investment Group up in New York, okay, the institutional firm that ends up hedging. Right now, volatility is high enough where, looking at the calendars, okay, is a nice trade below the money, because what ends up happening, and here, let me show you this graph. It's a little busy, so let me just take a look at the first 6 months. Let me take a look at only those things above a quarter, and let's get rid of a lot of other crap out too. We'll look, what would you be selling, Himanshu? What month would you want to sell? What month would you want to buy?
I would probably buy the July month.
Okay, and what would you like to sell?
I would start by selling. I mean, right now, if today's day is an indication, I would probably start selling next week. In other words, keep on selling the weeklies against your long-term puts.
Okay, let me explain to you why. Okay, Himanshu's trade has a theoretical edge for you. Whether he's right or he's wrong is, in my mind, almost immaterial if you decide to end up hedging. Once you make the decision to hedge, how do you do it the most efficient way? Here's what we're looking at. What you're looking at is the implied volatility of every single strike for the months that I have or the weeks that I have highlighted over here. So you can see February 13th is right here, and that's the yellow line. That's next week. The week after, February 20th, is in the green line. I asked him when he wanted to end up hedging, and by the way, right, I mean, he could have really walked into this one, and he didn't, because he's been doing this a long time. Okay, he said July. So I ended up choosing, okay, the July option over here, and that's the purple line down here. What did he say to give you some protection on the downside? He said about 5%. I have the graph set on the price on the bottom. Here's the current at the money, and then I chose 10% up, 10% down. So here's the 5% down line, okay, approximately. So what ended up happening is that Himanshu is buying a 19.4 vol, and he would be selling a 23.7 vol. So he's got a vol edge. Now, yes, if the market ends up dropping, that's $4, okay, that Himanshu would end up receiving for that option, by the way, which is a lot of money, right? 4 points down, okay, could end up losing money, and we could go below that. But this will, and for us to go down 5% net between now and by next Friday, at that point, the longer-term volatility, okay, the 6-month volatility out in July is going to end up starting to really pump up. So he carries a lot more Vega, okay, weight in this back month. Okay, if we look at the back month, it's going to end up having a much higher Vega weighting, and therefore he's going to end up making a lot more money on that back month. So in any type of a pullback, okay, this is a wonderful hedge to end up putting in place. And when we look to end up hedging, when we end up looking to hedge larger portfolios, we will use calendars or diagonals where we're buying extra puts in the back, because remember, what we're trying to do is hedge very, very large portfolios. As options traders, you know, what you end up doing is that you're going to hedge for most scenarios. What we have to end up hedging for is also black swans. So we have to end up wasting some of this great theta that he's going to end up having in place and some of this great Vega stuff by buying even a few extra puts further below the money, so that if we do have a 10% pullback, okay, we still made enough money for our clients. So it's a little bit different, okay, in the structure. But as for a downside hedge, looking at this, Himanshu, I think that you picked a really, really good spot, and being able to end up taking advantage of that weekly theta that would be coming out very rapidly would end up being a, you know, I think a very efficient and effective downside hedge.
Good. If it does go down, then that should definitely help us a lot. And David is saying that you picked a quarterly or a weekly July option, and that's still okay, Dave. As long as it is all the way out there in July, it should still work out.
It should. And, you know, the thing is that even if it doesn't, okay, this hedge, okay, yes, the market could rip higher and you'll lose money on the hedge. And that's where the sizing, okay, ends up coming into place. You know, if somebody ends up putting on this hedge because they really think the market's going to go down, and no longer is it a hedge, but it's actually a downside bet, and it doesn't work out, well, that's because they probably sized it too bigly. Whereas if they're just trying to hedge, you know, you size it and you do your what-if analysis. My portfolio is going to end up losing, you know, $50,000 if we come to this level. I'd like the hedge to end up stopping about half of that loss at this level, so therefore I need to do X number of contracts, right? That's where, right, we can't give them trading advice because we don't know what their positions are. We don't know what their risk tolerances are. You know, we don't know any of that stuff. So all we can end up really doing here is giving folks the information and talking about the trade-offs. What happens if? Okay.
Correct. Yep.
So, Himanshu, do you want to show any graphs or any of your stuff, or is there anything else that you'd want to end up talking about or showing? You know, if you want, I could end up bringing up the actual graph of the SPX, and if I end up coming over here and taking a look at that 1920, okay, the 1920 right here, so if I did a -1 here, and I ended up going out into July, and I did 1920 over here. I guess I'd have to do the 1925 is what it was. And I did one over here. And let's go to 1920, only so that it is a real calendar. And I know some people will say, oh, no, if you don't want to end up doing this, you can end up just clicking this, the position, and it just shows you your two here. So I will end up coming here and then unchecking it. So my cursor's in the right spot, but I still have to page down though to it. And I'm going to take that one off and bring it down one. Okay. And now what you can end up seeing is that with one contract, right, here's the live graph for the next week. Okay, here's where we currently are. We end up seeing about where, now remember, we haven't played with the skew, we haven't changed implied volatility, so the graph won't be perfect, but again, I have this set on 10%. You can see that over here, over the next 8 days. There are my colors. Here's the price along the bottom. I can end up seeing how much I would end up going. Now, if we do go down 5%, Himanshu, how much does the volatility go up?
If we were to go down by 5% in SPX, the walls would be probably close to about, right now, I think it'll go up by almost 5%, literally.
5%,
If it goes
and
down, if it goes down
we're-
in one, yes.
we're about 20, so if it goes up 5%, you think it'll go up about 25%.
Yeah.
Okay, so I'm going to end up bringing everything up just by 30, for example. Now over here, I can end up taking a look and seeing here at 5 or 6%. I can see what the implied volatility would end up being, okay, and what my P&L would end up being with my vol shocks. Okay, so if I end up, let's just take a look and say if it goes down 6%. Okay, I can see that the hedge would end up making approximately $1,245, less than what we would make if we were only down about 4%, right? Because we're already past it. But if I take a look at the 1321 that I would end up making without any adjustments to vol, look at what happens if vol ended up jumping 30%. Now, granted, I'm jumping both front month and back month, and I do realize that the front month implied volatility would go up more than the back month, so the gain wouldn't be that full $3,500, but it also ends up having a time, okay, lag, where if I ended up walking this through here, instead of making only $1,000, take a look at what I end up having. I'm going to end up making twice that in a week. And then what ends up happening in a week from now, if that ends up happening, Himanshu, you know the front month Vega goes to 0 at expiration. So the jump in vol won't have so much of an effect on those short-term options, but it will have a bigger effect on that July. So your gains are probably going to end up being, pretty significant, okay, if you do end up getting that pullback. And that's why I love that hedge.
That's very true. Yeah, the Vega works. In fact, that's why I was just thinking that July might be good, but, having chosen October might have been better because if the further out you are, the more the Vega helps you if the market drops like a rock.
Yes. So one of the things that ends up happening, and this is why I like, when we start talking about this stuff, I like thinkorswim being able to program my graphs and stuff. But when I'm talking option stuff, I'm going to, let me go and take a look at, the end of September, and let me also take a look at December. And now I can take a look at my implied volatility, okay, and I can see where we are, and I can end up holding it over any one of the strikes, and I can get a really good idea, right? And it's a T graph, so I can end up rotating it. I can end up seeing where my volatilities are. I can see, since it's time-based on the bottom here, you can see these weeklies are all clustered, okay, over the next few weeks. But then we go up to July, September, and December, and you can see that they're much further out. And I can see my implied volatility is. If I'm not sure about, is this a good or a bad time to be doing that, one of the things that I can look at is I'll come over here and I'll take a look at what the constant 30-day, right, this is a constant like the VIX. It's a constant 30-day roll to implied volatility, the 60-day. And I can see, are my volatilities a little bit high here in the 90 or 120-day area, and instead of looking at 2 years, let's just look at 3 months. That's a little bit here. They're elevated a little bit, but not very much. I mean, not compared to some of the other drops. If you take a look, if we end up dropping, I can tell you, if we make new lows and we have an ugly sell-off, we're going to be higher than this level. Yep. Okay. And we're not going to end up jumping from, 18 vols. We're going to be moving up to, 25 vols or even higher. So, I take a look at it, and it's, again, what's your objective? Himanshu talked about hedging, right? And this is a good hedge. So anyway, Himanshu, let me pass you the ball. If you want to end up showing any graphs or anything from your desktop, I just, because we've been running this thing with LiveVol, I wanted to be able to end up showing some of the stuff because, Himanshu, I don't know if we shared with you, but all of our clients end up getting at least a nickel off of the IB, I'm sorry, a dime off the IB contracts, a nickel off of the contract costs for Lival. And if they had signed up for any of our services, like, for example, I know that later tonight, Amy Meisner is going to be talking about her service. They get a dime off of the IV, off of the Lival contract, and 15 cents off of the IB. So that brings them down to 55 cents a contract, no commission. So unless you were one of the really, really early Thinkorswim guys, those are, I think, the most competitive rates that you're going to end up finding any place.
That's true. I agree, yeah. 55 cents is bloody good. And no ticket charge either, right?
No ticket charges.
Nice.
Yeah.
Very nice.
Okay,
Can
what
you
are you
guys
showing
see
us on
my,
yes.
Can you guys see my screen?
We can.
Yes.
Okay. Actually, more or less what you just showed was exactly what I had also planned. I also usually have the 200-period moving average because most of the big boys go by this. We also know that more often than not, prices are going to bounce off this thing. And it more or less did that again today as well. But we have this resistance up here, the first resistance, second resistance. So even if it takes out this sloping trend line, it could go up here and then stall and then really come back down. The CCI is also telling us that being short right now might be a better way to proceed. And as I was saying earlier, this is where also if you look at the last 20 years, you will see that what you see right now is almost exactly what we had in the year 2000, right here. I had it highlighted, and it's almost identical to where we are right now. We have this little downtrend line over here. This is the horizontal resistance line. It never went above. Well, it did go above the sloping downtrend line, but it never actually cleared the horizontal line. And the minute it went below the 200 MA, it just cratered all the way down to here.
Once it turned the 200 from resistance into, from support into resistance, it lasted in resistance for over a year.
Oh yeah, actually more than a year. This
2
is
years, right? Almost.
This is 2000. This is 01. This is 02, and somewhere in 03, around April, is when it finally went above it, close to 2.5 years. And, the spiders actually lost almost close to 50%, from 152 to 77, very close to 50%. And if that happens here as well, then, from 212, we could be down to somewhere close to 120, which would be, I don't even know. There are enough supports down here. But we know that it will definitely at least go up till 182.
Yeah.
If it does go down, it's going to go down at least up till here. And if it closes below this as well, then we can either pray or be properly hedged so that we don't get hurt.
Yeah. Well, while prayer has its place, it's not a good trading strategy.
That's very true, yeah. But generally, if you are hedged, along with your hedge, occasionally praying does help. I'm telling you that. Two strategies together are better than one.
This is true. You know what? We learned that when I had a stock picker, okay, a Russian computer scientist by the name of Eugene Yaskin came in, and he talked about using multiple factors when doing his analysis. And the same thing was said by several of our technical analysts who've come on. Taking a look at multiple time frames or looking at multiple things makes a lot of sense. Now, I know that you used Woodies CCI. Now, you and I have known about Woodies CCI for a long time, but can you, for the folks that don't know it, can you just mention a little bit about, because your CCI chart was, mine was just a plain vanilla one. You got like the super fancy one. What's Woodies CCI?
Woody Ken Woods is a trader. He was a pit trader once upon a time in the not in the SIBO, but the other one, the CBOT.
The CME? CBOT. Okay.
CBOT. He was a futures trader, and the gentleman, the guy who actually came up with the CCI. Damn, I forget his name, Dave something or the other. He also used to live in Chicago at that point in time, and they got together, and this guy, the founder, the inventor of CCI indicator, sat with him and sort of showed him the whole gamut of what CCI can do. And Ken was literally, he was like, with this, I don't need anything else. And he did very well from that point on, and around 2002, he started his own room called Woodies CCI, which was free at that point in time. And he actually trades the futures, the EFs, the TF, the Qs, the bonds, the ZBs, on a 5-minute and a 3-minute chart using only the this particular Woodies CCI. And what really amazed me was the fact that a lot of time he doesn't even have the actual chart at all. He literally has something like this. He's only looking at the CCI as opposed to the chart. And he literally would take the signals right off the CCI only, which was, which I personally found a little frightening, in the sense that I'm like, dude, if you don't even look at the chart, how do you know whether there is support or resistance and this and that? And he said, you know what? The peaks and the troughs of the CCI show you the support and resistance right there. Literally, he's like, if price went above the previous high, that means if CCI went above the previous high, the price just went above the previous high as well. And I was like, okay, fine. But anyway, I tried it out. And then what happened was, I mean, I was not really interested in day trading the futures. But there was a lady who lives in Connecticut, pretty close to me here. And she started using the CCI on stocks, looking only at daily charts. And and out of the 6 separate strategies using only the CCI, she used only one. And she was making so much money that suddenly all her friends and families, they just started shoving money at her, saying, hey, trade mine as well, trade mine as well. So I sat down with her, and she sort of gave me a general principle of how to trade the CCI. Since then, I've always been using this. And the one part that I use the most is the fact that this particular Woodies CCI, it actually tells you when the underlying is trending or flat or normal. Normal means it is not flat, but it is not trending either. But if it is flat, you will see that the top bar will turn brown in color. See, right over here, you can see it was chopping. And it turned brown over here. So even if you are not looking at the price, it tells you that the underlying is flat, so don't even bother entering the trade right now. When it goes to green, then it tells you that it is trending. Plus, it also tells you right over here whether it is normal or trending or stuff like that. And one of the strategies within the CCI repository is something called the ZLR. The ZLR stands for the Zero Line Reject. So every time that price, this is the zero line right here, the middle line. So every time price comes to the zero line and then rejects it, so right over here would be your entry. That is a signal that the market is going to, again, continue in that same direction. there are some particular nuances in the sense that in this case, the previous high never reached plus 100. So this ZLR is not as good as, say, this ZLR when the CCI reached above plus 100, and then it came down a little bit and then rejected the zero line. So right over here, if you go, you would have made from 199 all the way to, say, 207 on a daily chart. And of course, there are other strategies like you can even draw trend lines on the CCI, and when the trend line is broken, you go in that particular direction. So for example, you can have a trend line like this, and when this trend line got broken on the upside, you could go long. Yeah. But I personally decided that out of the 6 different ways of using the CCI, the trend continuation signal was the only one that I was interested in, because I have tried being a counter trend guy many times in my life, and usually I end up getting beaten to death. Then I come out of it, and then not only that, the worst thing is that after I come out, after I resurface, I tend to beat myself up as to why the hell did I do it in the first place. So it's a double whammy that I get. So with CCI, generally the thing is that once it closes above the plus 100 line, then it comes back down towards the zero line, and then it rejects, meaning goes back again towards the plus 100 line. On that bar, in the last 5 minutes, if you were to buy a call or the stock itself, there is like almost an 86% probability that you will end up making at least a penny. In other words, it will be a profitable trade. It works on daily charts, on weekly charts, on 5-minute charts. I actually use it a whole lot more on weeklies than on dailies. Look at this. This is the weekly chart. Here is a ZLR, a beautiful ZLR. You get a signal here, and if you went over there, you are still in it, because you never got a signal to get the hell out. Well, actually, you did get a signal right over here, but you could have said, hey,
Himanshu, there's a slight delay. So when you're saying here and there, could you give us the dates?
The date right here is, I was looking here, on the week of 7/1, 2013, in the spiders was that was one of the signals. Prior to that, we had signals, literally, we had the first signal on 9/3/12. We had another signal on 12/31/12, yet another on 3/4/13, yet another one on 4/8, yet another one on 4/22, a big one on 7/1, another big one on 9/2. And as you can see, had you stuck to the weekly chart and used the CCI, you would have just kept on buying calls or selling puts. Or in my case, as I just kept on buying call calendars. I mean, it was literally a no-brainer. You just sit there and say, God, I'm getting bored of this now. The only mitigating factor is that, you are making money, so you're like, okay, fine. I'm getting bored, but I'm making money, so let's not complain too much.
By the way, to all our listeners, I wish you have the same boredom.
Say that again? I wish I had the same boredom.
To all of our members who are listening, I wish that they would be as bored as you are making money, okay, just watching the money come in. Okay, I'm wishing them, okay, the same boredom that you have. Oh, isn't this boring? I'm making money again.
Hey, if they want to sign up for my calendar class, they will learn how to get bored really well.
So do you use these when you're positioning your calendars or adjusting them? How do you end up using your technicals, okay, for doing your option trade? And we'll get to your roundtable in a few minutes. But how do you end up using this? Are you using it for positioning?
Well, as far as now again, because this is, let's say, this is a weekly chart. What I normally do is, let's say if I have something like SPX, right, and I'm getting a signal right over here, then what I will do is, in that case, mostly I will try and look at the previous high, but in this particular case, the previous high has already been, it's almost there at the previous high. Normally then what I'll do is I will literally go about 30 points out and buy a call calendar, but again, because this is weekly, my short calls will be anywhere from a minimum of 40 days out to a maximum of 60 days out. I also tend to not put all my buy all my contracts at the same time, because this is like literally a 50, 40 to a 60-day trade. I may put 1/3 of my position 30 points out. Once the market comes and touches my calendar, I will buy another set of calendars 30 points further up. Remember my triple calendar? Ultimately, my single calendar will turn into a triple, after which I keep it as a triple on the upside. On the downside, I will gladly convert it into a quadruple or even a quintuple calendar, especially on a put side. Because on a put side...
Because the volatility is helping you, right?
Exactly, yes. And the best part is that if the market really drops like a rock, all I have to do is buy back some of the short puts and let the long ones ride it out.
Yes. I think that's really important because, one of the things I think for a lot of our members, learning your corrective strategies when the market is, exploding all over the place by simply buying, a single put, where we're buying back a single short or a few single shorts that you end up having, is a very easy adjustment strategy. You and I have talked, Himanshu, and that trying to end up saying, well, if this happens, I'm just going to end up putting on this four-way iron butterfly, okay, at this you're never going to get a four-way butterfly off, okay, when the market's moving that badly. But this is one of the reasons why, one of the things that Tom and I have tried very, very hard to bring, okay, our community, are people who actually trade and are not just educators, because there's a very, very big difference of what works theoretically versus what actually works when you go to end up using it. And Himanshu, right? I mean, I know that you end up having this. Those scars, okay, that you and I have are well earned.
Yes, I agree. They are well earned. By the way, before we jump off the topic, I just want to point something out. On this weekly chart, you will see that the Woodies CCI is showing you a flat. So when the market is flat, this is a great idea to put on a double calendar on either side, at the high and at the previous low. And usually it will work out more often than not, because you are flat. Of course, flat also means that you might be getting into a squeeze and it could burst out in one direction or the other. But before it does that, you have ample time to actually make enough money on theta anyway.
And are you going to be on your roundtable? For those of you who haven't looked at the calendar, not this Thursday, but a week from Thursday, Himanshu is going to end up being on the roundtable, and he's going to be talking about how it's in calendar. Would you just kind of give us a small little preview? I mean, I guess you already have been doing it, but what are you going to be covering in the roundtable?
Well, in the roundtable, I will more or less be educating the folks on what a calendar is, because even though a lot of people who are option traders, they like iron condors and iron butterflies, not too many actually really go into calendars for some strange reason. So, and of course, if they happen to already know what calendars are, then I'll be done in like 30 seconds. And the rest of the time, I will talk about why use calendars, number one, how calendars can actually be used to make consistent income, how calendars can even be tailored to your own personal directional bias. You can have bullish calendars, bearish calendars, neutral calendars. you can use calendars as a hedge, how you can use calendars as a stock replacement strategy. And that actually is a great one because like some of the stocks that I would really love to buy, you know, like Netflixes and CMGs and ISRG, all of them are like $300, $400, $500, $700. And while I would love to own 1,000 shares of CMG, there's no way in hell I'm going to put $730,000 down. But there is a better way, using calendars, where I control 1,000 shares of CMG for, you know, less than 15K. And still Sorry, go ahead.
I was going to say, you know, Tom and I are doing a covered call class, and last week we gave an example on how to end up using either a 6-month or a 12-month, option, as a stock replacement, and you can really end up taking down the capital you need to end up putting in to end up making money on the trade. But I think even more importantly than that, because you're using a spread, you can actually define your risk better. It's always important. A lot of people end up saying, you know, your risk-reward ratio has become a little bit better. You know, for Chipotle to end up moving $100 up or $100 down, it is a big move, but you know, it's done it quite often in the past.
Very often, yes.
Whereas, you know, you might end up losing 15% of your capital, but so the options trades doesn't make the risk go away. And in some ways, you might even be risking a greater percentage of your investment, but it's all about the trade-offs because you can also make a much, much greater percentage than what you're risking.
Exactly.
Right? And with calendars, and I think what's so good about and I'm so glad that you're coming on, is that most of our traders, tend to end up liking to look at one single month because it's one set of volatilities, right? It's the volatility just in that month, so everything's the same except for the skew. Obviously, you know, as you go further below the money, we saw that the put skews were up compared to others. But that ends up meaning that if you are a keen watcher of the volatility, and most people on Thinkorswim couldn't because you didn't have the graph that I showed from Liveball, you can actually end up watching that. And the only way you could end up trading calendars if you were the guy who was watching the implied volatility and you knew exactly what was. Now, I know that you used to always do that, Himanshu, so you could end up seeing that. So a lot of people ended up saying, oh, this is more difficult. But I think that between, having somebody who's traded them as long as you have, somebody who understands the volatility in different months, and to also be able to end up using some of the tools that we now end up having that, you know, I think a lot of traders didn't end up knowing that they could end up getting or didn't have, you know, a few years ago. I really look forward to this because I think it opens a whole new area for a large chunk of our member population.
That's good, yeah. The one of the things that I would like to emphasize when I'm teaching about calendars is that it also is a very forgiving trade. If you are paying attention, it usually doesn't kill you too much.
Mm-hmm.
As opposed to doing iron condors or ratio spreads and stuff like that. But again, you know, I mean, if you know what you are doing, if you have a plan and if you follow that plan, then all strategies work well. But calendars are also great for people who are very lazy, which I happen to be, by the way.
Now, you said it was very forgiving. Can you explain why that's so and how the trade will end up being a little bit slower than, say, a butterfly or a vertical or something else that's all done in the same month?
Okay, well, one reason that it is forgiving, usually we are always concerned on the downside, right? We are like, okay, if it drops like a rock, and then, you know, everything goes to hell. At least our positions go to hell. With a calendar, because you are a positive Vega trade, a really strong down move will actually help you a little bit. So that is one of the reasons why you don't really have to panic at the very last minute when the underlying is really doing something like this. The other reason also is that,
drop.
yeah, and the other reason also is that even if you have to like sort of adjust it, if you want to like, let's say, if you have 10 calendars and you want to take half off and place them again further below or further above, it is much easier to do that. It is much easier to do a two-legged trade in a fast-moving market than a four-legged trade, as we already know. But even better is the fact that you can then convert, if it is really moving fast and if you don't even want to do a two-legged trade, what you can do, as I just spoke earlier, is you can convert a call calendar into a call diagram. If it's a put calendar and if it is dropping like a rock, then you just buy back one put. And suddenly your delta is negative, your vega is still positive, your theta remains positive, so you are being helped in three different ways simultaneously with the put calendar and the market dropping like a rock. So there are many, many different ways. Again, I personally like the calendars because it is more geared towards my personality, which is type Z.
Type Z, okay. I'll buy it. What's type Z?
It is not type A, B, C, D, or all the way down to that W. So
okay, you got me.
But again, if you are a type A personality, then instead of doing long-term calendars, you can do weekly calendars. And you can still do very well. I still find weekly calendars to be, instead of looking at a weekly chart, look at a 1 hour chart, and every time you get a signal, buy a, sell the next week and buy the week further out or the month further out. And it'll still work out. So what I normally do is, in my previous incarnation, I used to use a lot of different things, many, many different indicators, many different support, resistance, Fibonacci's, all these special studies that are out there. But finally, I settled down on like 1 or 2 indicators, just 1 or 2, and based on that, I will take the signal. So, if it's a $4 stock, then I will just buy the stock. If it is something like SPX, I will just go to a previous high and buy a call calendar or a put calendar. And Marilyn is asking me, what signal are you using? I'm using the CCI right now. I also use, I occasionally also use the MACD divergence. And I'm a great proponent of ADX, which shows you the strength. So if I'm getting a signal in CCI and ADX is rising as well, then, I may, instead of buying 3 contracts, I may buy 6, kind of thing. But, yeah, so to answer your original question, some of the things that I will be covering will be the ones that I just mentioned, and then finally will be the adjustments. Usually it is in the adjustments that most people screw up, or sometimes they don't screw up. What happens is that they make the adjustment and the market just turns around and goes the other way. And a lot of us are just left holding the bag, wondering like, should I just remove my adjustment that I put on, or should I leave it there, or should I do something else? And Paul is asking me about my magic blue line. Oh, it's still there, Paul. The magic blue line, I will tell you all about it in the class.
We've been going just about an hour, and I don't want to steal too much of your thunder for next Thursday, because a lot of people may not have seen this, and then you're going to have to end up going over some stuff a lot.
Right,
so next Thursday, 4:30 in the afternoon, Himanshu's going to come in, go through his calendars, okay, what he's going to be doing. Himanshu's also agreed to actually, for those that want to end up learning even more about this stuff, he's going to end up putting together a class offering for us, okay, with special pricing for our members that we really end up appreciating. And Himanshu, I'm so glad, Himanshu, like myself, was a consultant for a bunch of years in technology and a lot of financial services companies, but he still does it. So at times, Himanshu goes dark on me for a while because they're sending him all over the world working on stuff. So we're really, really glad that you have the time to be able to come in, talk to our folks today, do a presentation, and being able to end up offering this class. I know that I'm very, very excited about it because it's calendars are, if you learn them properly, I think probably one of the best ways and easiest ways to end up making money. When you take a look at a lot of the stuff that our community trades, put butterflies below the money with extra calls, John Locke M3 or M21 type stuff, there's a lot more management in those. The P&L can end up coming in, or when you're trading butterflies, usually go out much, much quicker. I think that the butterflies and having a series of them, and Stephen Shannon and I, and you remember this, Himanshu, we ended up taking a look at, and we had traded a series of calendars, and we tried to, and if anybody remembers the chain of flies, the chain of butterflies we did, we basically we basically took the same management concept that Himanshu's talking about in his triple calendar, and we just substituted butterflies. We had to make a bunch of adjustments, but I mean, it was the same, process. The only issue that we ended up having where Himanshu is like maybe just changing his calendar into a vertical and moving one spread, not one spread, just like picking up one option and moving it 5 points. We were having to put on, 3 or 4 new options every time we wanted to do it, and then if we had ever stepped on the wing of the butterfly wouldn't fly anymore, and we'd lose money. And so it was very, very difficult. I like the simplicity of the strategy. The challenge that I had, with it was that I did not trade it as my sole primary trade. So I couldn't see what the previous implied volatilities looked like on that 60-day or 90-day option. I didn't know what the skews had changed, and it was basically, you talked about Woody, or I forgot who it was, who ended up trading and didn't only look at the CCI. And you guys know that Tom's a pilot. Really difficult to end up flying by instruments, not looking out your window if you don't have instruments, And that's what I felt like, So it was rather difficult. Now that we have the instruments to be able to end up measuring, and Himanshu's going to end up going through this, I'm really, really looking forward to this, and I hope the rest of our communities. Himanshu, on behalf of everybody, I'd really like to end up thanking you. Anything you'd like to end up closing with before we turn it over to Tom to kind of just do a little bit of housekeeping before we close for the day?
Not really, though. Marilyn has a question here. She asks, what makes a calendar better than a diagonal, like a double diagonal for you? Nothing makes a calendar better than a diagonal, except it's like saying, why do you think a steak is better than shrimp? It's just that I like steak more than I like shrimp, that's all. I do diagonals too, and they work just as well. The point is that in anything that we do in the trading arena, make sure you have a plan and make sure you follow the plan. Sometimes even when you follow the plan, you will lose money, but at least you can chalk it up to saying, at least I followed my plan. I did my max loss of 10, 20%, whatever it was. But most of the times, if you follow your plan, chances are that in the long run, you will end up making money. So to answer your question, calendars are not better than diagonals. I just happen to like them more. That's all.
Okay, very, very fair. Very, very fair. Himanshu, thank you very, very much. And I know that we really look forward to this next Thursday. Tom, do you want to end up?
By the way, next Thursday is the 12th, not this Thursday, meaning not this week, the week after.
Right. Not this
Correct.
Thursday, but next Thursday. Tom, do you just want to end up wrapping up and letting everybody know our calendar for the rest of the week, both tonight and Thursday and everything?
Yeah, we've got a lot
busy,
going on.
busy guy getting stuff.
Amy Meiser tonight at 7 is going to do an introduction into her weird or trade alerts. Let's see, tomorrow Curtis Allen's going to show us his February Russell M3 that he just closed, and he said he's been doing pretty well in this choppy market, so that'll be interesting to see. Thursday we've got Larry Richards from Quanti Carlo presenting their new automated option backtesting software. I think they're going to actually start releasing it this week. And we got our class, your trading group, Jim. And then next week, Kevin Nichols is going to do his monthly live vault software training. So we've got a lot going on in the next week.
We certainly do. We certainly do. Tom, thank you very, very much. Himanshu, thank you very much. And for those of you who are going to end up signing on to watch Amy like I am, I will see you in an hour and a half. And those who aren't, I'll see you later in the week. Thanks a lot, guys.
Okay. See you all later.
And thanks again, Himanshu. Really appreciate it.
No problem, Tom. See you all at 7.
Okay. Ron.